Hello, I'm Greg Bennell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights to help boost your trading potential. Coming up, U.S. markets are kicking off the shortened trading week lower. That's after back-to-back weekly losses. Traders this week bracing for the Fed minutes, fresh inflation clues, trying to get some guidance on where the markets might be headed in the coming days. Plus, our trading debaters, they are here. They are ready to take on Newmont. Does gold strength translate into stock upside, or is the rally losing steam? They're going to share some bull and bear option strategies, and we're going to preview Deere earnings for a read on global growth and industrial demand. That is all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. We are half an hour into the trading day. We had a 3-day holiday. The Americans had a 3-day holiday. We are back at it. The S&P 500 is decidedly lower to start this shortened week. Still a lot of questions out there about AI disruption. Who will the winners be? Who will the losers be? Still front and center for investors. Let's jump into the heat map and see what's happening today. We do have strength in the U.S. financials today, but we're not seeing tech play along. We do have the S&P 500, as we said, pulling back NVIDIA, Microsoft, Broadcom, Google. I can spell them all out for you. Palantir lower in the screen. Some of the software stocks. Salesforce still getting hit today. So it's definitely something to watch. We want to check in on Newmont as well. Check out that one-year chart. This is the stock of the hour, the whole topic of our debate. Why did we pick this one to debate? Well, let's run through what we're seeing here. Obviously, the stock chart is telling us a story. It is the world's largest gold mining company. It's been in business for more than 100 years. Only gold producer listed on the S&P 500, and it's gold. As we saw the underlying precious metal make its historic run, so did shares of Newmont benefit. What's next, though? That is the question. Let's head over to the desk. Jason Natick and Hiran Amin from our direct investing educational team. These are the guys who are going to hash it out. Gentlemen, welcome back to another edition of Money Talk Live. Not Money Talk Live, TD Active Trader Live. Yeah. That's what happens when you ad-lib. Before we get into the debate, though, ad-lib after a long weekend. Before we get going with our debate, just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Options trading carries high risk, may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. All right, the stock of the hour, let's get to it. Newmont Corporation, we'll get some time on the clock. You get your 2.5 minutes to make your cases. Then we have time to counter. Then we jump into the platform with option strategies. Got a lot ahead of us. We drew from the hat. You're not going to see it live. Actually, I did a really complicated coin toss thing where I confused myself for a second, but at the end we decided. I did the flip. I was like, wait a minute, does that mean Jason is the bull? Jason is the bull. Why don't you kick things off?
I did end up in that whole hullabaloo with the bull, so let's kick things off. But before we peek under the hood for Newmont, as you mentioned, they're the world's largest gold producer. Almost 6 million ounces annually, with some of the best mines with the largest reserves in the industry. And thanks to their Project Catalyst, where they invested $500 million in themselves into cost-saving initiatives, they've reduced their all-in sustaining costs to just a shade over $1,500 an ounce, with gold around $5,000 an ounce and projections to go up to $5,600 an ounce later in 2026. That's a tidy profit we can see continue to roll in. But it's not just the price of gold that moves the needle for Newmont. One of the big things that jumps out to me is they've got a really high concentration of tier 1 assets in really stable jurisdictions. So what we're talking about here, Newmont has deliberately shifted. They've actually divested some of their smaller mines, less profitable mines into a tier 1 asset kind of focused portfolio. Large, long life mines in politically stable jurisdictions like North America and Australia. This has lower geopolitical risk than many of their competitors who are operating in heavily emerging market areas. And it's these more predictable for permitting, operating expenses, greater operational consistencies, and fewer disruptions and risks. And then second of all, biggest producer is scale. The scale, something they use to their advantage. They're once again the largest producer, They give operational scale that few, if any, competitors can match. They have large production bases spread across, which spreads their fixed costs across more ounces, better access to capital and financial markets, and the ability to maintain dividends, which is important here. And it's one of those things, smaller producers have, if they have just problems with one mine, has unforeseen impacts that really are going to materially impact their results. Newmont's diversification can play well. But let's get ourselves in the chart, because it's really been something, a strong thing, a thing of beauty here for Newmont, really, if we're talking about. This is the 2025 that I've got over here. It's been a nice, pretty sharp climb in prices, but what I've noted here on the chart, there's been times of pause and reflection, and then investors and traders have continued to push the stock up. So an orderly advance, sure, but the stock has been continuing to be pushed up along with gold itself along the way. Noting here, late in 2025, we have an inverse head and shoulder after kind of one of the deeper kind of pullbacks on the price. Then we saw the stock get projected and fulfilled out of that inverse head and shoulders towards its new highs. I do want to also look to show you, when we look at a shorter term time frame on the chart, we've seen an additional pullback off the top of it, maybe some profit taking coming in. We do see a double bottom that's formed that was pushing the price up into earnings.
All right, so if Jay's letter was, argument there was like a love letter or a poem, he probably would have titled it A Thing of Beauty.
Yeah.
What does a bear say?
All right, here's what
Bull
the
says
bear
Thing of
has to
Beauty.
say. You know, Newmont is basically what happens when investors forget that what goes up must come down, and especially when it's riding a rocket made of fool's gold, and that's how I'm going to present it. So you have the bulls that are going to chant like gold super cycle forever, but you know there's a delusion that we're at the peak of that. And so here are three realities that I want to dispel that delusion about. Starting first with production, it's catering. So Newmont cranked out 6.85 million attributable gold ounces in 2024. For their 2025, it's just 5.9 million. We're talking about a 15% haircut. With core one tier assets flat at 5.6 million ounces. And forecasts already, management has come out in front of it and said we're expecting lower production for 2026 due to mine sequencing issues. So they're not growing. They're divesting like a hoarder on eBay. No organic ounces, just reshuffling deck chairs on the SSS depletion. My second point is going to be their costs. You know, Jay pointed out they've got cost controls. I have something that argues against that. So when gold rallies, but the cost of digging it also rallies out as well. So their AISC, or all-in sustaining costs, exploded 15% to $1,651 per ounce versus $1,516 last year by its own measure. They are the highest amongst its competitors. So let me repeat, they're basically digging up less gold at higher costs. It's like a restaurant that's basically offering smaller portions for higher prices and expecting an applause from the crowd. And then the final thing we're going to talk about is extreme valuation. They're really priced high. When you look at their correction from 41 to 121, they had 135% joyride rate going up. And then the World Gold Council also says, who are supposed to be bullish on gold, they're expecting a 5 to 20% crash if Trump's policies actually work. So we're seeing rising yields, stronger dollar, risk on rotation back. Let's go into the charts because I'm going flying blind right now. With the charts, we have a 4-hour chart put up. What I just wanted to point out, we've seen a violent break of the bullish run that's happened. And this is critical of Newmont, which is a leverage play on gold. So if you do have this correction happen, you're looking from a high price of 137 coming down to 103 in just a matter of 5 days. So there's no arguing that, yes, they're riding sort of the bull gold wave, but when you do have those corrections, and you're seeing a little bit of froth right now is the way I would categorize it, because you see bigger reddish bullish candles that are emerging whenever you do have these strong sell-offs, and it's kind of going sideways and choppy right now where the market's kind of still in a sort of jostling and indecision phase. So the key levels really is we see support cracking, it's fallen down as 103, and that's going to be a key level to retrace down to.
A thing of beauty versus fool's gold. You got 3 minutes to go at it.
All right, let's do that. So before we even dive into Newmont itself, I do want to talk. Let's take a step back and talk about gold. There's always going to be uncertainty where it's going to go, but there's 4 things that I really think are playing that's going to keep, regardless if we have margins that are tightening or if we have costs that are increasing. The asset itself has got legs here. We've got geopolitical uncertainty, right? Global measures that are really playing into gold safe haven nature. Central bank stockpiling, China, Poland, Kazakhstan, decoupling from the U.S. dollar, right? So that's big things. Currency hedging over mounting debt in the the U.S. And then we've also got new non-traditional buyers that are soaking up gold. Talking about like crypto firms like Tether are buying gold to wrap their crypto tokens. So we've got still some bullish headwinds kind of pushing the product, which is really leading to kind of a strong.
But you're at the peak cycle, Jay. Like even with all this buying, it's already priced into the price that you're looking at. So markets already priced that in, already forward looking at whatever the demand is going to be. Unless they're digging up a whole new tranche of gold that's going to come out, the market's already priced in. It's a price perfection story. The other thing, when you look at Newmont, and you talked about like hedging and currency hedging and all those other things, Newmont specifically has abandoned kind of their hedging practices, what they had in place before. They're not protecting against gold. So they're basically flying with gold. So if gold corrects, but it's a leverage play, you're going to see an outsized move on Newmont that's happening. And I want to go back to ASIC, because at the end of the day, you have to look at overall costs and the margin numbers that they have. The ASIC is the highest. Agnico sits at about $1,300 on the top end. Barrick sits at $1,560 per ounce. And Newmont sits at $1,630 per ounce in what is arguably what you call tier one jurisdictions, where they should have more cost controls in place.
Right, but Newmont, its edge isn't necessarily lowest costs or fastest growth. We're talking scale, we're talking asset quality, we're talking longevity. Focusing on all three of those key points is that some expansions that Newmont is actually putting into place into one of its top mines in Australia. When we're thinking about the Tanami expansion 2, this is something that's really providing life into the future of a really high-end asset. Gold production in that region is going to be increasing from 150,000 to 200 ounces per year based on that in this really stable environment. So it's an opportunity for Newmont to be preparing itself for continued growth, continued stability.
You're talking about a drop of a bucket. How many ounces is that comparatively to what they usually produce? It's just, they're trying to make, jostling what you said, they divested some mines out of those, right?
They have.
To make up for it?
But they've also, if you brought up leverage to a degree, it's these assets they're finding, they're not based on the core principle, they're not as high performing, they're not as stable. They've been able to bring in $4.3 billion into their balance sheet in combined sales by divesting these smaller assets. So these are opportunities to make the company more nimble while still generating those stable, consistent profits.
That's just financial jostling. It's just like a juggling. This is like financial Botox. It's not actual growth. They're just tearing some assets, making some up to make the numbers balance. What is really concerning is why they're estimating lower production, even with all of this jostling that's happening.
That extra day for the weekend really put a fire in your guys' bellies. All right, very nice, very nice. We're going to jump into the platform now and talk about possible options trades. Why don't we start with the bull side?
Yeah, let's start with the bull side. So one of the things I wanted to kind of focus on here was an opportunity to kind of give ourselves a chance to kind of use the more volatile time that we're experiencing around an earnings event and use that to our advantage to kind of play a long-term bullish play. So the thought here would be to do a long call diagonal spread. The way that works out is you're buying something longer term, typically closer to the money, and then we're going to be selling another call to kind of offset those costs with the idea that it's going to expire worthless and out of the money, and we'll get an opportunity to do this on a repetitive basis to kind of really offset that long-term cost, because longer-term options, especially when they're closer to the money, are going to be more expensive. So we can get a discount on that asset and hopefully have it pay for itself while maintaining a bullish view on Newmont over the longer term. So jumping into the charts, we can give a quick talk through of that kind of really wordy explanation that I gave to everybody. This might look a little like a lot going on here, but what I've got drawn on the screen here is these vertical red lines. These are the different kind of expiration cycles. So for instance, we're going to be buying something long term in green out to the middle of June, but I've set up 2-week cycles that if we're able to sell a near the money option, but giving it enough room that it's away from the current prices that you're going to have a low probability of being assigned, and do that on a repetitive basis through the life cycle of the long-term call. Those premiums that are going to be stacking up over time will bring down that cost. When I did the trade last week, the cost was around $11.50. That's come down this morning. Let's take a look, see where we're at right now in terms of the trade. We're now talking it's going to be even less expensive, probably around $10. So we're still saving ourselves $1.50 there. But it's really that repetitive nature and being selective with the strike prices. As time goes on, we're able to choose those low probability of assignment strike prices to keep bringing that premium to offsetting that long-term cost that we've got on the trade.
All right, so this strategy, if it works for you, you're bringing down the costs over time. If it doesn't work for you,
Well, to further clarify the bring down the cost, you're actually even creating an environment where you still maintain the bullish nature and you actually have undefined gain potential on the trades. So not only are you making it less expensive, you still hold unlimited upside gain potential. With this particular trade, you are looking to ensure that you're not assigned up front, because the quicker you're assigned, the more expensive that trade is, because you've paid more up front. So if you do get assigned, you're looking to typically try and avoid that by managing the trade a little early and maybe trying to roll it out to another week for hopefully more credit. But if you do happen to get assigned, then you're going to be effectively the max loss will be what you paid for the trade, but it's also you can offset that assignment by exercising your closer to the money call that you already own.
Okay, interesting stuff, Jay. What about the possible bear side options trade?
Yeah, Greg. So the way, if you were bearish, one way you could play it is obviously look at a directional play. And part of the thesis behind that is we've seen recently when we saw the big correction happen on gold going from 5,600 to 4,900, that's created really outsized moves on a gold player like Newmont. So looking at the charts, really, if we are seeing at least, you're baking in a 15 to 20% correction if we do see that, especially if the backdrop, if we see some more geopolitical tensions easing up in the Middle East, the dollar going a little bit stronger, then that's going to be all sort of headwinds for gold. So one trade you could look at doing is what's called a double bear spread trade. So essentially what we're doing here, it's composed of two trades, or two spreads, I should say. One's a bear call spread on the upside. This is a credit trade, essentially, what we're doing here. So we're looking to target previous resistance area. We saw a previous high over here on the stock. So we're looking to sell just outside of that. And then 140 call going onto the March cycle and looking to buy 155. Now, the reason I want to do this is because the volatility profile of the stock is sitting in the 83rd percentile, which means the premiums are pretty high right now, given that gold is volatile and therefore the stock as well. And on the downside, we want to capture the downside move if we do see that correction happen. So here we're looking to buy what was at the money before the start of the show today, was just outside of the money, was looking to buy the 120 strike put and sell the 110 strike put. Now you'll notice one thing, I've done a sort of an uneven width on either side of them. There's a $15 width on the top side. The reason I want to do this, I want to collect a little bit more premium. And I've made the downside tighter width at $10 because the market's expecting about a $10 move. If we do see a correction, we want it to come down to at least the 110. That would give us the full amount there. So right now the trade, and I should have done the review, but prior to the morning, before we saw the stock move down a bit, this trade was costing me about $1 at the midpoint. $1 to put this trade on. That's a debit, so $100 on a single contract is what we would have there. Now, it is a directional trade, so our break-even's 119. So I'm going to just get ahead of this and say, okay, so in terms of a max profit, you want it to go down, and you want it to go down to $110. If that happens, you're basically taking the $10 width minus what you paid, which is $1, so you're making $900 as your max gain on this trade on a single contract. But here's where it gets a little bit uneven. If it doesn't go this way, if it stays between the 140 and 110, that's great. We only lose $1 what we put in. However, if it does move to the upside and goes beyond the 140 and touches the upper limit of 155, that's a max loss, and it's going to be this full width. So we're going to lose $15 plus the $1 we spent on this trade, so we're losing $16 in total, or $1,600 on a single contract. So there is a bit of uneven skew on this. This is, as I said, this is a very directional play. We really want it to either go down or stay at least below the 140 to just cap our losses at the dollar.
All right, interesting possible option strategies there. Thanks for laying that out. Thanks for arguing out the bull and bear cases for Newmont. And just a reminder to our viewers that this debate was for educational purposes and does not reflect our personal opinions about the stock. Now, before we move on, Jason, you're going to elaborate about the options statistics.
Yeah, I thought it was very fitting because both in Heron's explanation and my trade that we mocked up, we want to know a lot about volatility, right? Because volatility is kind of one of those key extrinsic values that kind of really help us determine and kind of, how inflated or how juicy is an option premium, if you will. But let's jump into the platform. I'll show exactly where you can find that. So I've moved myself over to the trading tab here. That's kind of a system default tab for anybody new to the platform. We're going to be looking all the way towards the bottom. We've got this today's option statistics chevron. We can go ahead and give that an expand. You've got some interesting pricing information on the right-hand side that talks to you about, calls and puts being traded above or below their bid and ask. So if you want to dig into that, if you've got a really high need for information, that's there for you too. But focusing in on the left is where I think there's so much really good information for us to understand. Where investors are very common, you're used to looking at 52-week ranges for prices. Well, we actually give you a 52-week range for the implied volatility, that forward-looking volatility, and we give you the current IV percentile. So it's even more volatile than we had both discussed in our trades. It's now up into the 92nd percentile in terms of volatility. So it's right near the top end of its 52-week range. And if we look down towards the bottom, it's sitting at 61.41% volatility. What also is really cool about this is an opportunity to compare implied volatility, the forward-looking, with historical. That's your delivered volatility, right? So I get to track to see how volatile is the stock now based on how it's been in the past, and it's just more information, more data for me to understand. And it kind of basically in closing, it's one of those things. If it's not uncommon for people to be selling option strategies into high volatility and buying options when volatility is a little bit lower because you're expecting moves in the other direction with the IV.
All right, powerful tour there for our audience to take a look at. Thanks for that, Jay. If you at home have a question about the TD Active Trader platform, or if there's a stock you want to see our debaters go head-to-head on, just send us an email at td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try out the platform risk-free by opening a practice account. You click on the Try TD Active Trader button. Then when you're ready to switch to a live account, simply export your workspace and start trading for real. Time now to find out what's on our radar for the rest of the trading week. What are the events you're keeping an eye on? Hearing.
Yeah. We've got a big, data front week again, Greg. So I think the big thing for investors to keep in mind on is going to be on Friday is the PCE numbers. That's the personal consumption expenditures. That'll give just investors a read on consumer spending during the holiday filled month of December. This is December's read. And then a look, and then also match it, pair it up with what inflation came out with. But prior to that, we also have the FOMC meeting minutes coming out on Wednesday. So this is just going to give us insights into how policymakers were thinking about the rate path forward, obviously, with the reshuffle of the board coming in. Obviously there's Kevin Warsh stepping in on May. So what does that trajectory look like? And then coming back to PECE, the expectation is a 0.3% on total and the core. So core, remember, strips out the volatile energy and energy and food expenses out of it. So 0.3% month over month. This is also coming on the backs of CPI, which released that showed that inflation was slowing. As expected in January, rising 2.4% year over year, which is the lowest since May of last year. So the real question now is whether PCE confirms that inflation is steadily cooling or gives Fed sort of a reason to stay more cautious. And then there's one more thing that's coming on Friday that I marked was the GDP. GDP, this will be a first read on the U.S. growth for the last three months of 2025. And so they are really expecting a 2.8% growth. That is going to be a contraction from the third quarter, which came in really hot at 4.4%. So really, it's still going back to that story about the economy being in the K-shape, where higher income households and corporations are doing a lot of the heavy lifting so far. But on the earnings front, there's a big one coming out next Tuesday that I've got my eyes squarely focused on, and that's going to be Home Depot's earnings. So again, this is the American multinational home improvement retailer, of course. It's the largest home improvement retailer in the United States. So next Tuesday, before the opening bell, they're going to report the Q4 25 earnings. Expectation is $2.52. That is going to mark a 16% year-over-year decline in revenue of $38 billion, which marks a 4% year-over-year decline. So they're really navigating, they're sort of their first period of slowing sales in more than a decade. And management's also lowered the previous guidance that they put out. They were expecting gross margin compressions, about 2 basis points coming in as well for the full year. Now, it may not sound as much when you're talking about 2 basis points. However, it does amplify when you go down to the bottom of the sheet. But one of the big things that, investors want to keep an eye on was something you mentioned last earnings was storm-related demand wasn't there, consumer uncertainty, and housing market headwinds are still lingering for them.
Sorry, I was thinking about the name, right? You feel good about your job,
yeah.
You feel good about the value of your house, maybe you get things nice stuff, right?
Exactly.
You buy the new toilet, you may get a rec room going. You don't feel good, you don't.
Yeah. And a lot of it's going to range on that interest rates as well, what that means for the housing market if they get a prop. But one good sort of feel story coming out of that was their pro versus DIY segment. They really made some inroads in the pro segment and ecosystem. Really, that's translating to gains, especially on the AI front. And I just want to talk about two things. They have something they launched called Blueprint Takeoffs. It's a new AI-powered tool that helps pro customers create material lists and estimates faster and helps them with the checkout. And then they have something called Material List Builder AI, which is really meant for those big projects where they can put all the sort of materials together for entire projects for all different stakeholders that are built into there. So that's really going to be a sort of a tailwind for them. And coming into the price action, though, we've seen it sort of had a significant sort of corrective price action from its highs back in August, hitting that 420 mark. It's really sold off and hit those support at that 335 level. We have seen a short-term sort of intermediate uptrend forming now. There's a bullish pennant that's formed, which is really seen as a next leg up. Coming into this earnings and looking at previous earnings, there's about a $20 to $30 move to the upside or downside, depending on how it goes. But we are seeing more sort of larger red candles and bearish candles forming with stronger volume. However, we are seeing also on the positive side, the 50-day moving average just about to cross over the 150-day moving average after a little while since the November sell-offs there. So we can see, we want to see if this momentum carries forward and breaks above that 400 resistance, and that could set it on its gliding path over to 420. On the downside, we're looking at the 365 level as a sell-off just below the 50-day moving average there.
Always a fascinating one to watch, and you have another one too that tells us a little bit how about the planet's feeling about the economy.
Yeah, we've got definitely a bit of a global bellwether for sure. I'm talking Deere. Deere's coming up. They're reporting this Thursday on the 19th before the bell. Deere, if we don't know, they're the second largest tractor retailer in the world by total volume, but they've got a dominant market position in terms of market share of 60% in the all-important high horsepower segment of tractors, which have horsepower over 200, with the typical HHP tractor ranging from $150,000 to $700,000, big ticket items, so it's a lucrative market to be the big player in. Now, as we said, many analysts view Deere as a bellwether for the global economy, and with that in mind, there are global factors that influence companies of this scale with worldwide sales and manufacturing footprints around the world. We're talking tariffs on essential equipment for their manufacturing. We're talking tariffs on crops. We're talking lower commodity prices, which contributed to maybe even tighter, farming equipment budgets. We want to hear more as well as about the cyclical nature about the agricultural equipment spending here. And then you touched on AI from a Home Depot perspective. Hey, John Deere doesn't want to be left out of that as well. And so they're not just a heavy machinery company focusing on dusty fields here. This is a company that is rolling out fully autonomous tractors that utilize computer vision, machine learning, and they're all centrally connected thanks to partnerships with firms like SpaceX with the aims of having a fully autonomous production cycle by 2030. So big things are in the hopper here. But here are a few key numbers and facts that I'll be listing for when their earnings comes up later in the week. We've got your standard stuff like your earnings per share, $1.92, and revenues are on $7.6 billion. Analysts are expecting big increases over the same time period, 39 and 12% respectively. Tariff projections, this is a big one here. They've already expressed a $1.2 billion pre-tax hit. So if there's any change to that, that's going to be something for people to mull over. And lastly is around that precision and AI transformation. We're talking about that SaaS, that software as a service. How's that revenue projection looking going forward? But let's jump ourselves into the chart to wrap up Deere here. We can see 520 was kind of where it was bumping its head kind of earlier on in the spring and early summer of 2025. The company did dip itself down below. We saw a triple bottom previously towards the end of the year, which precipitated a big rise in the stock price. We saw the price come above the moving averages. We got a triple in the price moving averages. Now, as we come in through late December and early February, we saw this really steep increase. So we've got a potential kind of bullish continuation pennant forming. We're still playing out to see which way that'll break outside the pennant. Right now, we're testing the lower boundaries of that. So if we do break out on less than stellar news, then we can see pull back that 520 where I'd be looking. But if not, if we break out of the top side, typically your move coming in is something to expect on the move going out if you do get that continuation of a trend. So, big week coming up for Deere.
I don't know why I want to put a headline on everything today. That was my job like 20 years ago. Deere got SaaS.
Oh, you got SaaS. That is a good one.
I don't know. Maybe that'll be my retirement job. I'll go back to writing headlines. Guys, another great show. Thank you very much. Here in Jason Natick from our direct investing team. Before we sign off, we have an important reminder for our viewers. Bank impersonation scams are rising as we head into tax season. Fraudsters are sending emails and texts posing as financial institutions, often asking clients to click a link to confirm account details or complete tax forms, including W-8 requests. Watch for red flags like urgent language, requests for personal information, or unusual sender addresses. It's important to know TD will never send a text or email containing a link asking you to log in or submit tax forms. If you receive a message like this, do not click it. Report it to TD by forwarding the email or sending a screenshot of the text message to phishing@td.com. Important message for our audience there. That is our show for this week. We will be back on Thursday. Our guest is technical analyst Chris from Mullen. As always, investors should perform their own due diligence before engaging in trading, and thanks for watching.